if you look at a map of the U.S., the deepest orange is more in the Great Plains area.
Right.
But it extends up north coming into Illinois, but we're in the northern part of Illinois, of course. But this morning it was 100 degrees out, which for us is that's pretty hot, especially when humidity is at like 40 or 50%. So makes for a tough day outdoors.
Humidity is a Philadelphia given, and so we are used to that in the summers also. For whatever reason, the way we're shaped, it's humid, and so we can live with that. I don't think it quite made it to 100 today, but that's for Chicago, for a city that can get to minus, whatever at the drop of a hat. It's amazing you get up to 100 just as easily.
Yeah, it's crazy here.
Yeah. All right. Yeah, and we're getting, oh my God, Houston. It must be unbelievable. Richard Boback, who was a former student of mine, in another incarnation that you know about, Steve, Richard in Houston, that is just brutal in the summer. I wouldn't even think of I would just move to Alaska or something if I lived in Houston. Anyway, all right, well, got a lot to cover today, so I don't want to hold you up, Steve, and so what I would like to start with is just, a little quick intro. By popular demand, we have back Steve Lentz of Options U, and we really did get a great, reception from your last talk, Steve, about the OpScan formulas and how you can structure trades around the OpScan formulas. And today, you graciously agreed to come back and talk to us about credit spreads, essentially, a credit spread approach. And this is Steve's presentation on counter trend trading with option spreads. And I just think it's a really great approach. We, in the course that we teach, we go over credit spreads, and one of the points we make when we're presenting credit spreads and strategies surrounding credit spreads is that you need an indicator. We do not presume to know the best indicator to indicate whether a stock is going to be, or an index or an ETF is going to be a good candidate for a credit spread, which really means, a vertical spread that has a directional bias to it. And, the great thing about credit spreads is you can be wrong. You can be a little wrong and make money. You can be just, the market can be neutral and you'll make money, or of course, if it goes into your direction, you're going to make money. So it's a very forgiving trade in many ways, but it sure helps to have a reliable indicator to increase your edge and be able to make a business out of it. And you, Steve, you and I both know people who basically make a living, selling credit spreads.
Right.
So it's definitely a viable approach, and so we're all very excited to hear what you have to say, Steve. So I'm going to stop talking and just let you shoot. I do want everyone to know that this is being recorded. We are going to post it on our blog, hopefully over the next day or two, and anyone wants to watch again, be my guest and do that. So, okay. Steve, I'm going to give you the proverbial ball. You've got it now, and you can share your desktop whenever you wish.
Excellent. So if I share my desktop, I can come over here. All right, and hopefully you're now looking over my shoulder and looking at the title screen. Is that right?
We can see Discover Options, Counter Trend Trading.
Perfect.
With options using the RSI.
There you go. Okay, good. We're ready to go. Excellent. All right. This is something that we've been, at our company, we've been kind of teaching for a while and monitoring it and just seeing how robust it is over the years. And this is something I've always excited about speaking on, and something I really like to do is combine good common sense option spread construction with common sense technical analysis of the markets. And so the RSI is an indicator that I think can really give us an edge in doing this. And so, of course, we know that presented material is for educational purposes only and should not be construed as personalized advice, right? Options trading involves risk, and past results, which I will show you, back-tested results are not necessarily indicative of future performance. So we understand that, okay?
Yes.
All right. In the world of trading, setups are so easy to come by in so many textbooks, and really the exits are the devil in the details, I guess. And you got to have a trading plan, and I like football, and so I just like showing this because, if anyone had a game plan in the world of football, it was Vince Lombardi. And likewise in trading, we got to have a game plan for not only entering a trade, but how you exit. And so this is kind of something that I think we kind of have to embody in a philosophy of exiting a trade. And this one is pretty simple. And as I'm going to show you, the philosophy behind this is pretty easy to grasp. Here's the idea. In counter trend trading, all right, there's two approaches to finding basically what you feel is a market top or a market bottom, and then trading that. And so there's two. One of them, and this is the one we're going to deal with today, is what we call a one standard deviation challenge, meaning that we're going to challenge the market to move a full standard deviation before we exit the trade. And we use credit spreads for doing this. Now, there's another one that we teach in our program that time won't allow me to get to it today, but it's called a butterfly float or a calendar float. Basically, you put on a bullish or bearish butterfly or calendar, and if it doesn't quite work out immediately, well, you can put another one on and then kind of float it around a little bit and give yourself a real wide room for error in doing that. And that's one strategy we do talk about in our program, and that's something for you to consider later perhaps. And you could certainly use the RSI to use that. Okay, what's next? There we go. All right, here's the premise. When a trend is about to end, all right, no attempt at poetry here, but when a trend is about to end, we're going to sell option premium just over one standard deviation out of the money and then challenge the market to move that far. So that's just as an example. If the market's moving up and up and up,
right,
and we sense that it's about to end and top out, we're going to say, you know what, Mr. Market, we're going to go a standard deviation further away, upside,
right,
and challenge you to move that far even after you've come up all the distance that you have. We don't think, Mr. Market, that you have it in you to do that, so we're going to challenge you to do that and sell premium out there. And if you go up and hit that short strike, fine. We'll take our loss and walk away and lick our wounds. But we don't think you can do it, and then we'll collect the entire credit, and we'll just let it go to expiration. Okay? That's the premise.
I understand.
So,
I'm going to keep an eye on questions.
Okay.
So if anything comes up, would you like me to wait till the end? Or
well, now, Seth, you've seen the whole presentation. If you sense that I'm going to answer it in the next few slides, then go ahead and just let me go. But if you think that it's a question that I'm not going to necessarily get to, and we'll go ahead and interrupt. And
well, this really isn't a question. This is a comment saying no sound. Now, I think we would have heard from more than one person on that. Can others please chip in? Okay, John Lee is saying sound is back now. Okay, great. But if I see anything that I know is going to come up, Steve, I will delay that.
Okay.
Good.
Okay. Yeah, I find sometimes with WebEx, if the sound and the movement of the screens is too much, it bottles up the system a little bit. And if you just give it a room to breathe, then it catches up. All right, but the whole thing begs the question, when is a trend about to end?
Right.
And this is where the RSI indicator can really help us out in determining a likely top or bottom. And so we're going to look at the RSI and describe what it is, and we'll get into detail on how it's calculated and what the lines mean. Now, Seth, I don't know if you've talked about this, but in trading, you really want to make sure you understand the indicator that you're using on the screen.
Yeah.
I know I can't tell you how many people have come to me with ideas and stuff, and they just talk about an indicator, and to them it's just a line, but they don't understand the information behind the line. And so we're going to make sure that we understand the information behind the RSI.
Yes.
We'll look at a few different types of trading signals.
Yeah.
We'll establish a trading plan. We'll look at the anatomy of a couple trades, and then let's just see how that plan would have worked out in the past using our back trader feature to walk forward in time and see how well it would have done.
Great.
All right, what is the RSI? This thing was developed by Wells Wilder back in the 1970s. This book here, I have a copy in my office. It's just one of the foundational pieces on technical analysis really ever written. He came up with the concepts of directional movement indicator, the ADX. The whole notion of average true range was developed in this book. So this is where it comes from.
Is he still kicking?
He is.
Huh?
He is now the, I don't know if you've seen the whole thing on the Delta phenomena.
No.
All right. Well, he got off into this world of lunar patterns. Looking at the market from the standpoint of the lunar cycle. And I actually chased it down for a few days. I said, okay, I'm going to devote a few days here to dive in and see. And the information I got, now this was 7 years ago that I looked into this or so, and I came up, because there were actually a few researchers at the University of Michigan that chased it down, and they concluded the lunar cycle had no bearing on the stock market.
Okay.
But, yeah, I'll tell you, you talk to people that actually use it, they swear by it, but I don't know. I haven't seen it.
Well, I'll tell you, they say that more babies are born in hospitals around a full moon. I think that's an established fact that all doctors and nurses will tell you. It's not a myth.
No, I agree. I've heard the same thing.
Yeah, so there's something. I don't know if it has to do with the stock market, but it definitely has to do with babies.
It's one of those mysteries out there. You got to, because it does affect human behavior, and human behavior is all about the market. So,
absolutely,
you would think that there was a better connection that could be documented, and maybe Wells Wilder. I mean, look at the book he wrote. It's pretty darn important, and maybe time will tell. He charges quite a bit to be in his little Delta Club, though.
Okay.
So, all right, RSI. Here's the formula. Basically, look at the narrative there. A smoothed average of the ratio of the average gains to average losses. All right, and then it's normalized so that it is scaled between 0 and 100. So it's an oscillator moving back and forth between 0 and 100 depending on the price action.
Now, Steve, can you tell us what average of the ratio of average gains, a smooth average of the ratio of average gains of what, and average losses of what?
Well, if you look at price.
Okay.
So if you take a swath of price movement here,
right,
and you expand it out,
yeah,
what you do is you look at the closes only. Okay. So then I hit the button, and there it goes. You look at the closes, and you're looking at gains or losses from close to close.
Okay.
So if you're looking at only gains, let's say the ratio of gains, let's look at the gains that have occurred over the last 14 days. By the way, in the world of RSI, the default number is always 14. You have to go in and proactively change it in most charting programs.
Okay.
So here you have 1, 2, 3, 4, 5. There's 6 of the last 14 days that have had gains occur right here. And you can look at the average over 14 days. There's each of the gains there. You average that out, and you have an average gain of 8.58.
So when the Russell goes up, on average, it goes up 8.58 over this 14-day period when it has gone.
Correct.
Okay.
Correct. That's exactly right.
All right.
Then you look at the average losses, all right, and the average loss when it has occurred, when you average those out, it's 13.6. All right, and so now you take those two numbers and plug it in. Let me grab this thing. Is this going to let me grab it? There we go. Oops. Time out. There we go. All right. RSI. There's the formula, and we're looking at RS, 1 plus RS. So then you extrapolate it down to here. That's like 0.63 or something like that. So it's 100 divided by 1.63. You end up with 38.65. That's what your RSI value would be looking at just that formula, okay, right up here.
Okay.
Now, in the world of Wells Wilder, though, and in the world of software programming, you have to kind of get that book to understand what he was doing, because he really had, I'm going to call it a convoluted way of getting the actual RSI value, and he did it in a way that made it very conducive for someone keeping a spreadsheet by hand to be able to do it pretty quick. And then not to have to crunch the values each, from scratch every time.
Steve, can I just stop you here for a second?
Yeah.
Just to focus a minute on the formula. It looks to me like what the formula is saying is that that if the average up day is greater than the average down day, then that in turn will create a more positive RSI number than the reverse.
It'll be closer to 100 than 0.
It'll be closer to 100 than 0.
Right.
Yep. Okay. So the fact that it's in the denominator means it's actually reducing what's being taken out of 100, and therefore it would be a larger number. And so the reverse would be true in the reverse, that the smaller that fraction gets, the smaller the RSI gets.
Yes.
Gotcha. Okay. Okay, I'm with you.
Okay. Now, the way he did it, though, involves looking at the previous average gain value.
Right.
And I don't want to take the time to look at how he did it, but suffice to say, because you're always looking at the previous value and backing into it using the current gain or current loss, the RSI appearing on your software program may not be exactly what it is on someone else's charting program. Because if your chart goes back farther in time than someone else's, technically then there's going to be a small disparity.
Gotcha.
Okay. So what it does, though, is it creates this oscillator down here, this line. And when the market, has some, large, up days, you're going to see that the oscillator or the RSI can get pretty high. And then on a big down move like this, you'll see it generally follows price coming on down. And if you back out in time and look at it, you'll see in general that the price action pretty much follows what the RSI is doing. Okay, and so much so that some people and some systems out there actually use trend lines of the RSI itself, trend line breakouts on the RSI. I've seen some systems where they put moving averages on the RSI or some other type of creative trigger type line on the RSI itself to trigger trades in price. Using RSI as a surrogate for price, you can put a trigger line on it and have a trading system going on there.
I think I will jump in at this point because this is a question that is being asked on this subject. Bill King asks, have you looked at periods other than 14 days? Larry Connors has shown that 2-period RSI works best for short-term trading, 3 to 8 days.
Yeah, no, I've looked at the RSI 2-day. I have Connor's book that talks about that. And the key phrase there, though, is short-term trading, and what we're doing here is a totally different animal.
Right.
We're trying to look for long-term trend tops or bottoms, right, where we're going to now sell premium over 21 days out. Right. I think there's a lot of validity, and we have students in our group that also follow that 2-day RSI, but they're doing some very short-term trading. And I think I respect Connor's a lot. He's done a lot of good research, yeah, and I love that book, and he's done a good job there. But it's a totally different animal. Mm-hmm. The 2-period RSI produces a whole different type of signal.
Okay.
Okay. So, is there any other question, or should I go forward here? Okay.
Proceed.
All right. So, you got the RSI here, kind of tracking price pretty well. There's 2 types of trading signals that we should be aware of that are generated with the RSI. There's the overbought and oversold signals. Typically when RSI moves down below 30 and then comes up above 30, right, that's a good buy signal. And then when it goes up above 70 and comes down from, that's a good sell signal. Those kind of signals just don't occur that often, and you can kind of look at a long-term chart here and just once or twice a year, it seems. 2008 had a few more because of the crash really kind of brought in some, but you can kind of just see they just don't happen that much when RSI goes down below 30 or above 70. So that leaves us with the divergence type signals, and this is what really interests us. And when we talk about divergence, we're talking about when price makes a new higher low, right, and then the RSI fails to make a corresponding new higher low. In this case, we're saying that the price made a new low, right, and the RSI failed to make a new low. And when price went down and made a new low, that put us on an alert saying, okay, it's likely that this could be the market bottom here. We just have to wait for an up close to maybe jump in here. We just need to see some kind of semblance of market strength to indicate a good time to jump in and go bullish at this point. Okay? And then on the bearish side, when price makes a new high, right, and yet the RSI is failing to make a new high, that's telling us that the momentum to the upside is now slowing down, and on a down close, that might be a good time to assume that the trend is close to ending if it hasn't already.
So you're waiting for a divergence, and you're waiting for at least one day which is consistent with the theory of that divergence, right?
Correct. We would wait, in this case, we would wait for the first down close, right, to enter a trade. We want to see then the fulfillment of that bullish or bearish move, at least just one day into it.
Okay.
Exactly. Now, that's the approach I took with this. Now, some people might want to wait, certainly there's validity in waiting for a bar's low to be penetrated, or maybe a 2-bar low to be exceeded on the downside. That would, any of those make sense. I just went with the first down close at the first up close. But I think we see, though, if you think of it in average gains and average losses, that's what RSI is telling us. When the price is making a new high, right, yet the indicator itself is not making a new high, that's telling you that the ratio of average gains to losses is now waning, and it's a way of telling us that, hey, the mountaintop the peak is within sight here. Right. It's flattening. The momentum is flattening out. And at this point is where we would say, you know what? The trend appears like it's about to end. All right. At this point, we're going to now sell option premium a standard deviation away, mm-hmm, and challenge the market to move that far. So here the market's moving up, It's diverged from RSI. It's telling us that the momentum is waiting, and now we're going to say, Mr. Market, we don't think you can hit, what are we at, 835? We don't think you can hit 870 or 890 or whatever it is, a standard deviation up. We think you don't have it in you because of the way that the momentum is now shifting, going down here.
Yes.
And so we have to now kind of define our statistics and standard deviation and all that, just to kind of see what kind of a trading edge this would be. And we need to define for ourselves what would constitute a trading edge, because if you just went out and sold premium a standard deviation away on a random basis, you'd have a high probability of profit just on a random basis there.
Right.
And so why not just do that? Why do all this? Well, let's just see what kind of winning percentage we would have to constitute a winning edge here. And so here's the question: how often will an underlying asset touch a strike price that lies just outside a standard deviation? And so I can hear everyone's head twirling. Well, a standard deviation is 68%, and you're calculating it out that way. But here, let's use a probability calculator, and this is one that we find in OptionView here. And this is a Monte Carlo-based probability calculator, so it's done through a series of iterations to come up with the statistics. And this is just an example here, but if we have our price at 830, and we're putting in a value of 20, now that 20, I'm just using it as an example. Okay, it's not anything that I'm ready to show you yet. We will get to that in a bit. Let's just go out 30 days, and if you did that in any good probability calculator, you're going to get then a series of borders. And in a probability calculator, you'll see the border of the first standard deviation sitting here, and then the second and third. And then it gives you the values. Now here's the deal. These borders are as of expiration, all right, in 30 days. In 30 days, price will end up within these borders 68% of the time. Okay? Now, the second standard deviation is stuck out there at about 95, and then the third would be at about 99, and we're accounting for the tails way over here, the occasional,
black swan.
The black swans are out there.
Right.
Now, here's and I may have to erase this, so let me do that. Now, here's the real question, though. This is as of expiration.
Right.
And if you go and sell premium out there just beyond one standard deviation, the question isn't where is it going to be at expiration. We're very concerned with the probability of these borders ever getting touched between now and then. Okay? And so in a probability calculator, what we can do is put in two targets. And just for fun, I always like to do this. I like to put into my targets. Let's just say let's put in a target of the first standard deviation borders here. And in our probability calculator, all right, you can see clearly in the middle the probability of the market finishing between those two targets, 68%. All right?
Right there.
Here is the most important statistic that we want, though. The probability of those borders ever being touched between now and then. Remember, what's our trading rule to get out of this thing? If we sell premium a standard deviation away, we're going to exit the trade when? Either at expiration when we make all our money, or when the market moves and hits that short strike. What's the probability of our short strike ever getting touched? And you can see here, roughly, on a random basis, you're pretty much looking at something in the vicinity of 1 time in 4.
Okay.
Meaning that randomly you could sell premium a standard deviation away and you should win 75% of the time. And if after going through all this gyration work with the RSI and analyzing the market, if you come up with a system that doesn't make money more than 75% of the time, well, you know that you,
right.
you know, I'll tell you, if it's less than 75, maybe you should just, go opposite. Because randomly it's 75. You should beat 75 by a lot.
Yeah.
To have an edge. So 75 is the magic number after we get through with all this.
Okay.
All right. All right. Any questions at this point, or?
No. So far we have no questions. I think.
All right.
Very
Cool.
clear.
Let me get a sip of my carbonated drink, and hopefully we'll be okay there. Here we go.
Good.
All right. So here's our trading plan now. I think you can kind of see the divergence condition at the top.
Right.
Right, we need a divergence condition. All right, let's say so on a bullish, okay, the index makes lower lows, the RSI fails to make a lower low. We have the trigger then. We need an up close.
Right.
On that up close, we're going to put on a bull put spread with the short strike located just over 1 standard deviation out of the money at the first strike beyond a standard deviation. And if you don't use option view, you can use a probability calculator or, to figure that out.
Right.
We're going to go to the first month with over 21 days remaining. And we want to make sure that we're going to get a 5% yield at least on our spread. Okay, we don't want to, put on a spread and just get a few pennies for it after slippage and commissions. We want their, yeah.
Let me just jump in. I think that folks who may not be thoroughly familiar with options might be asking, why would you wait? Why would you not trade within a month which has less than 21 days remaining?
Well, I think the farther out in time you go, the more you're letting the probabilities play themselves out. All right, and so if you were to go under 21 days, let's say you're in expiration week or there's 4 days left.
Right.
Well, you can have a lot happen in 4 days. I guess theoretically you could do it. It's just that I find, and Seth, you're very experienced at this whole thing with the deviations and going out further in time. I know some of your approaches, you guys are looking at standard deviations as of 1 and 2 days out. I think you'll have days where you can go over a standard deviation or two more often, it seems, on a day-by-day basis than you will, say, on the basis of several weeks.
Right. And I think just to make it even a more simple concept, when you're within 21 days, a 1 standard deviation move is not very far. If you're out, less than 21 days, then you can get some decent premium for the credit spread. And, I think you're going to have trouble getting a 5% yield unless you're awful close to the money, a week before expiration or 10 days before expiration. You just, when you actually trade these, it'll be obvious that, within that 21-day period, it's just going to be too close. Comfort. So this is sort of probably, I'm guessing, arrived at more just from practical utilization of the credit spreads. That you need some to get a decent yield and feel comfortably far enough from the money. It's got to be more than 21 days.
Yeah.
So, okay.
Yeah, and then we can talk about weeklies and expiration week. We generally want to avoid that, so you're starting really there and moving out.
That's right. Exactly. Okay, great. Good.
Now, something that's not, let's see, one thing to talk about a little bit is in determining a standard deviation, and I think maybe, let's see, on the bearish trades, we're going just the opposite on the bearish.
Right.
But what we're doing is, let's see, I want to go back up here. To the value that goes in here into the projected volatility to get your standard deviation.
Right.
We like to use the implied volatility of the at-the-money call option.
Yes.
Just pick that, go with it. If you want to average it with the at-the-money put, that's fine. Theoretically, they should be very, very close together because of arbitrage and conversions and reversals and all that. So just take the at-the-money call option, pop it in there, and get your deviations and go with that. That's the advice that we give. Just call it a day by doing that.
Yes, right.
We're using the implied volatility of the options to determine a projected standard deviation. We're not using historical vol.
Yes.
Okay, just to be clear, we want to use the implied volatility of the options to determine that. Okay, so for bearish, it's the same. We wait for index to make higher highs with divergence, and then we want to down close. All right, so risk management, exiting. We got to have a plan. Real simple. If it touches the short strike, we're out, or we let it expire worthless, and we make all our money. Okay? Nothing could be simpler.
Let me jump in here, Steve. As a practical matter, do you find yourself, when trading this, actually allowing it to expire? Or do you find yourself watching the credit spread shrink down to such a small number that the remaining, potential profit just isn't worth the risk of it getting all blown with, an unexpected move?
I've done it both ways, Seth. I like to, I can think of, when I'm sitting here at the computer all day, and if it's down to pennies and there's still some time left,
right.
Well, then, I may as well remove it and then free up the capital for some other things.
Right.
But on the other hand, I have gone on vacation and let it expire worthless, and then I'll have a resting order to get me out on an emergency basis. But I'm doing that on assets that have very liquid options where the spreads between the bid and asks are very small.
Yeah.
And so
your method, you not only save the debit you've got to pay to close it, but you also save the commissions.
Yeah.
So,
a
lot to be said for it, but you just hate sitting there. As you say, I think that's probably the criteria. Are you babysitting the position, or did you go off on vacation and go with the probabilities? And probably over time, you're better off letting them expire. But I don't know that many traders that can sit there all day and watch a credit spread with a nickel left in it and not be tempted to close it.
Well, and no, because if you're working your account and employing most or all of your capital,
right.
You want to free up that capital and put it into something where the yields where you can start generating fatter yields immedially.
That's a great. So you're really making a kind of an opportunity cost argument, and that may outweigh the commissions and the and the debit by a lot.
Mm-hmm.
Yeah, great point. Okay, good.
All right, so here's the anatomy of a couple trades. Looking on the left part of the screen, walk forward, you can see, if you look carefully, we have some divergence in price in the RSI. Now, look at the red arrow pointed down tells us when we would have gotten in.
Right.
Look at what happened, though. I mean, at that point, we would have, say, sold way up there. We would have sold an 800 way up here. The short strike would have been up here. But look at this. Price went against us. It didn't go up and tag the standard deviation, certainly, because then it came down and wobbled around for a bit. But this is the beauty of this. You mentioned it earlier, Seth, you have a lot of room for error here.
Yeah.
And, trading the underlying, that big up move probably would have blown it out. On many technical trading systems, if you were just trading the underlying index.
Yeah.
But so here, this trade would have worked out. I mean, that spread up there would have expired worthless, and you would have been fine. Here's what it would have looked like back then. This is using OptionView's BackTrader module, where we can go back in time and get historical option prices. And you can see I took the at-the-money call implied volatility,
Right.
popped it in the volatility box. In OptionView, we like to paint the strikes a color so that we know which ones lie within the first and second and third standard deviations.
Right.
So this is the first strike just outside the first standard deviation. We sell it for $250. We buy the next strike out. We capture that credit, and then we're off to the races.
Steve, what slide is this we're looking at right now?
Oh, what number?
Yes, because I'm going to want to refer back to it a little bit later.
Okay, I'm going to hit escape and go back to it.
Oh, I'm sorry. I thought you might be seeing it. I wasn't seeing it.
Do you want to keep your ink in? No, I want to discard those, so we're good. So let's go back. That was slide 29.
Okay, fine.
Okay.
Okay.
All right.
And I had one other question before you went on, which is the only thing that I'm having a reaction to as to the need for there to be a confirmatory, in this case, down day, a bearish signal, is on those days you've got, the market moving against you, sort of shrinking your credit spread.
Yes.
And so you're kind of chasing the market a little bit. I almost would think the reverse, that you'd want one good last up day, to get as much premium as you could get before the predicted down move. But I guess what is that? Do you avoid that because it just makes it much less safe?
I see the point there.
Yeah.
That's almost a personality thing. I've always liked to wait for a small confirmation of the move in the direction I expect.
Right.
Gosh, we have people in our office, they're shorter term traders, and they will jump in before that confirmation. Not on this type of a system, but on other stuff they do. And I've watched some of them get hurt because they don't wait for that confirmation. Maybe the previous daily the previous daily high or low being taken out, being penetrated first. Right. Some kind of move, but that's me. To your point, I think that's a good point. Now if you have traders that want to jump in and go for it, yeah, I could see that you're going to get more credit.
Right.
If you don't wait for that confirming day. And to that end, I guess there's a personality thing.
Yeah, I think it's probably, time would tell. You back-tested this based on the one confirmatory day, right?
Yes, correct.
You don't really know how it would come out if you didn't wait for that one confirmatory day.
It'd be easy to recast, though.
Yes.
It'd be, just go back and look at all those dates and just simply look at the day that the divergence happened and go for it.
Right. It'd be interesting to look at that one day if the free time you have.
Exactly.
All right. So Derek's asking, this trade's 46 days out. That seems different than the 30 we were talking about. Derek, I think all that Steve said was anything greater than 21. I didn't think you had a max. Well, you're talking about the very next month that has at least 21 days in it, correct, Steve?
Correct. This one has June at 18.
Yeah, right.
So we had to go to July here. Now, that example with 30 days, the point of that example was to simply demonstrate that we need at least a 75% winning percentage.
Right.
That in any time frame, the probability of your one standard deviation border getting hit is 25%, one time in 4. So randomly, this 5 lot will get hit one time in 4 on a random basis.
Right.
Okay. All right, should I keep going?
Please.
Okay. All right, let's look at the next one. Okay, we just got done with that trade on the left. Do you see go ahead and just look, and let's see if you guys can, moving from the left part of the screen, moving to the right, do you see the next divergence that occurred? You don't have to type in your answer, just kind of guess and see if you can find it where price made a new higher low, and the oscillator, the RSI, failed to make a new higher low. And it should be pretty kind of obvious once you look at it, and now you can see it. The price made a new low probably on the 15th of July, and the RSI clearly failed to make a new low. And on that day, on the 15th, the antennas would have gone up, and you would have said, aha, you know what, the next up close showing some strength, you know, is probably a good indicator that this downtrend is about to end. And in this case, it certainly did. In this case, a standard deviation away, we would have sold in August 600, which would have been really clearly way out of the money, and it would have expired worthless just fine. That's what it would have looked like.
Selling put credit spreads on July 15, 2008. That's what you call tempting fate. But you didn't, of course, you didn't know it at that point.
No, and I think this would have been fine. This turned out to be just fine.
It wasn't until, I guess, sort of mid to late September that all the trouble started.
Oh, yeah, right. Oh, yeah. Absolutely. Yeah, no, 2008 was that was interesting. Well, and you'll see here the few losses that we did have, you know, you'll see coming up here. All right, so this is what the credit spread would have looked like back then. All right, let's look at testing results. Had we gone back and taken a look here, I'll show you how well this would have done, taking every divergence that occurred in the Russell here. Here's the disclaimer. We understand that, you know, these are just hypotheticals, right? This isn't from a real account. Here it is. All right, here are the results. Starting in 05, going through just recently here, we had 42 trades total, 42 signals, both bullish and bearish, winning trades 39, losing trades 3. Pretty darn good. Now that means our winning percentage is at 93%, and that kind of confirms for us the viability of this, because it's over that 75 mark, which is the random number. And so that kind of proves that there's some strong validity to using RSI divergences and getting that trading edge. Now, when you do lose, you can lose, you know, a significant amount more than what you're trying to make. So you need to be aware of that. And also, in our testing, look at that, 2 consecutive losses. And this is where kind of this is the tough part, you know. If you do this approach and you have 2 consecutive losses, pretty much you're going to write it off. At least the natural human emotion would be to just write it off. But if you go through the testing, you can see how it works. Let's see, what's our next screen? Yeah, there we go. You'll know that, you know, that those 2 losses occurred right around here, where 2008, it was a tough, you know, very, very unusual time. And that's where the 2 losses occurred. And then otherwise, you can see that the equity curve, the hypothetical equity curve, worked out just fine.
Yeah, this is not for people, I don't want people to get confused. This is a return on investment kind of an analysis. This is not a price chart. But it's interesting that it looks a little bit like a price chart in that you had a down move when the market crashed. And to be fair about this, I don't know that many income traders who were trading in October 2008. It just was, and it's the only time I really can remember that many people pulling out. But I would say 90+% of the income traders I knew had pulled out because it just, you know, it was just ridiculous. So it is possible that a little bit of human judgment might have come in here, and you might have said, you know, this isn't exactly the time to do a spread which is based on the evaporation of time and, you know, income and theta and so forth. This might be a time to just sort of be on the sidelines for that kind of strategy. But so I would argue that with real human intervention, you would not necessarily have had the 2 losses in a row.
Right. Well, if you had a volatility component saying, when the volatility of the market is through the moon like this,
yeah.
Don't do it. But, of course, we didn't have that here. We just took every signal, of course. And, of course, also we didn't increase the contract size. This is a constant contract size, for the entire 5-6 years. Certainly, had you increased contract size, it would have been a bit of a different story, but that's kind of how we like to do our testing, is keep that part constant.
Okay.
So, but
anyway.
Robert
Lanka is asking, can a trader use OpScan to identify divergent opportunities in different securities?
Unfortunately not. OpScan does not include technical analysis type tools like that. I like to use Metastock. I like to program custom things in Metastock to show me, to scan for divergences. If you can program in one of those charting programs, you can certainly get that.
Steve, I had a question for you, which is, just seems to me that, and I could definitely be wrong about this. It all depends on how the testing goes, but you had a couple of losses in there. Now, admittedly, you don't lose that often with this indicator, but when you do lose, they can get pretty hefty, and it looks like they're knocking out an average of 3, maybe even a little bit more than 3 times average winnings, if I'm not mistaken.
Yeah, right here.
So it's about, I guess, well, maybe a little less than 3, the average losing trade.
Right.
You wonder if you had just come up with an interim cutoff, so that if it didn't hit, and I know you have no way of knowing this because you'd have to look back at all your data, but I'm just sort of putting it out there. As a general observation, would you say if you had cut it off at 2 times, for example, if your P&L got as bad as 2 times your average earnings, average win, then you cut it off, do you think that would cause you to have more losing months?
I would certainly. There would have been some of those 42. Some of those 39 winners.
Right.
Probably at some point were showing a loss of twice what the credit was.
Yeah.
At some point, and then the market either came back or it fizzled out going the wrong way, and then you ended up making all your money.
And normally in income trades, you don't want your losing months to be, 3 times your average winning month, something like that. But this is different. This is directional. You have a real high win rate on it, and anyone who wants to do something like this needs to realize, every once in a while you're going to be crawling, you're going to be clawing back up to 0, in a strategy like this. And the key to it is to keep doing it. If I don't know how many traders just quit on things right after a losing month, and it's about the worst thing you can do. If you have a strategy that you're comfortable with, you've tested it, you've live traded it, and you have a losing month, well, you expected that, and so, my concern, the larger the max loss gets in relation to the average loss, or I should say it better, the larger the average loss gets in relation to the average gain, the bigger that number is, the more people tend to just psychologically bail out on it before they let the probabilities actually play themselves out. Just sort of. So anyway, what you're saying is it ended up not emerging. You have such an amazing win rate on this that you didn't have to really worry about a max loss, is what I'm hearing.
Not too much, no. And what you just said, I think, is so good. I'm sure we've all made the analogy that selling premium is so often like being an insurance company.
Yeah.
Right? And likewise here, if you lose 1 time in 10,
right.
If you really are putting on the mindset of an insurance company, really and truly, think about, when an insurance company loses on an account, they can lose pretty big.
Yeah.
And so, but to extrapolate the analogy of an insurance company even farther,
right.
Relative to their entire portfolio, every little account they have is extremely small.
Yeah.
And so you're on something like this, you don't want to load the boat on one trade because of that one time in 10 that you can get hit real hard.
Yeah.
Be the insurance company, go really small and find a whole bunch of these divergence trades and put on little tiny small trades in divergent markets.
Right, and then hopefully you'll get some offsetting each other so that you'll have a relatively smooth income stream, over time. If you're
Yeah. The one standard deviation challenge is really an insurance type statistical play.
Right.
Because you're playing the odds. You just got to make sure that you're well over that 75% winning mark, and then you have an edge, and you just simply work it.
Well, that is great, and so I think everyone, probably a key fact here is, well, first of all, this is a great example of how you take technical analysis indicators and then apply them to option spreads, and you marry the two, and you get these, wonderful win rates and a wonderful system. This happens, and the other big point I want to say is that, we're talking 3-4 times a year here. This is not the kind of trade you do to pay your mortgage and so forth. That you leave that to other income trades. This is a speculative, directional kind of a trade. Even though it works out great, you're only going to be able to play it, it looks like, 3 or 4 times a year. So it's not a steady income producer kind of a trade.
Yeah, on an equity index. Yeah, on one market. Yep.
All right, Derek, and this will be our last question. Then we're gonna wrap up. We try to keep the sessions to an hour, as you probably see. Can you show us how to chart that RSI on OptionView? Does OptionView have an RSI?
Oh, sure. In OptionView, just bring up a price chart. And then in that price chart, you can set up RSI by clicking the settings button and dialing up as the lower indicator in the screen. It's one of the standard indicators in OptionView.
Great. So it will give you it will default to the 14-day RSI.
It'll default to the 14, and you can change that number if you want. But we always keep it at 14. Yep.
So what, it shows up as a little mini graph at the bottom below the price chart?
Exactly, just like what Metastock did. Yep.
I see.
Yep.
Great.
Yep.
Wow. Well, Steve, this has been awesome, and I know everybody who is watching it live and everyone who will watch it when we post it on the blog, appreciates your effort. Anything else going on in OptionView you want to tell us about, or are we good?
Oh gosh. No, we got a good, we're just trying to beat the weather here, of course, but if you're interested in stuff we do, you could go to discoveroptions.com, check us out. We have a good team here, and we just love doing this stuff and talking about options and doing more research and trying to get better and better.
Great. Well, Steve, I want to, on behalf of the Options Tribe, thank you very, very much for everything you've done today. In conclusion, just wanted to give a little teaser for our next session next week, and that is as follows. We've got next week a presentation by Dave Schramm, an Options Tribe member who has developed a particular trading technique using a price indicator to manage deltas in options income trading. It's going to be a great presentation. Dave's a great guy. Those of you who came to our first Options Tribe meeting, you may remember Dave was the moderator with me, and he's a super guy and a very, very good trader. So you go ahead and please sign up next week. We'll get out the announcement shortly for that. My email address, if you have any questions about today's presentation or anything else, is sfroiberg@smb Here's my Twitter address for my various tweets, and check out our blog, SMBtraining.com. Lots of great information and insights into trading of all types, published by lots of traders and guest bloggers as well from SMB, and so I think you'd really enjoy that. And of course, we'd love you to check out our options training program. Details on this URL whenever you get a chance. You just go to the SMBtraining.com website and look for programs, click down to options, and that's where you'll find us. So on behalf of the Options Tribe, again, thank you very much, Steve. It's been great. Stay cool. Take a glass of iced tea, jump in the pool or whatever, and we will see you next week. Bye-bye.